How is reinsurance helpful to insurance companies? In two ways. 1. It reduces the insurance company's exposure to risk, and as a consequence 2. The insurance company can take on more risks, reducing the risk that a single loss will ruin the book. There are two forms of reinsurance: quota share and surplus treaty. 1. Quota share. The insurance company has an agreement with the reinsurer that they will insure a percentage of every risk and the reinsurer covers the remainder of the risk. So if the reinsurer has 75% of the risk, then a claim for $1 million would be paid by $250,000 insurers, $750,000 reinsurer. 2. Surplus treaty. The agreement between the insurer and the reinsurer is that the reinsurer will pay any amount of a claim in excess of a certain figure, to an agreed limit, with the original insurer covering the rest. The original insurer may take out a second, or third etc. layer of insurance. Example: Layer 1 is $2 million in excess of $500,000 and Layer 2 is $2,500,000 in excess of $2,500,000. A claim for $6 million occurs. The original insurer pays the first $500,000, the first reinsurer pays the next $2 million and third reinsurer pays $2,500,000. This totals $5 million, leaving the balance $1 million to be paid by the original insurer, who has therefore only paid $1,500,000 of the claim. 3. Simply put, it is akin to refinancing in banking. In banks, the loans are sold to other interested financiers who will take a share of the loan on them, freeing the primary financier to the extent of refinancing bankers' share. 4. Similarly, insurers also place the insurance received with other interested insurers either in part or in full. So, the insurance of A with insurer M is no more with M, but with N or O either in part or in full, even as the primary contract is between A and M. 5. This is a general practice and it helps to spread risks widely and losses are spread far and wide, instead of remaining in the hands of one entity, resulting in better liquidity and risk diversion. Reinsurance spreads large losses over many more policyholders. It also allows a small company to take on larger risks that may, otherwise, jeopardize their limited surplus. Reinsurance has existed in many forms, not just reinsurance companies. Carriers have often had agreement with other similar carriers to share premium and losses.